Every nation on Earth today carries debt. The United States owes around $38 trillion, Japan about $9 trillion, and together the world's total debt has reached a staggering $315 trillion, roughly 3 times the size of the global economy. But here's the terrifying paradox. If everyone owes money, then who exactly is owed? The answer isn't what most people expect. When you trace the chain of creditors and uncover who truly holds the debt, the picture becomes unsettling. The truth is, the world doesn't owe money to any single entity. It owes money to itself. This outcome wasn't accidental. Over the course of 3 centuries, 4 influential bankers deliberately designed a financial system that ensures debt can never truly be repaid. They created a framework where governments must borrow endlessly, where interest perpetually flows upward, and where those who built the system profit from every loan, every crisis, and every bailout. This isn't speculation or conspiracy theory, it's historical fact. The meetings happened, the contracts exist, and the mechanisms are well documented. Once you understand how the system was built, it becomes clear. The $38 trillion of U.S. debt isn't a flaw to fix, it's the system functioning exactly as intended.
To understand how this trap was created, we must look back to the 4 architects and the key moments when the modern debt system was engineered. Before 1694, monarchs borrowed money the traditional way, from merchants or wealthy nobles, promising repayment with interest. If a king couldn't repay, he defaulted, and lenders bore the loss. Debt was risky for creditors and humiliating for rulers, but it was temporary, either repaid or wiped out. The system always resets. Then came William Paterson, a Scottish merchant and financial schemer who had failed multiple times to make his fortune. In 1691, he came up with an idea that would change the course of history. England was at war with France, and King William III was desperate for funds. The treasury was empty. Tax revenues couldn't cover war expenses, and traditional lenders refused to extend new credit because England had defaulted before. Paterson's idea would solve the king's problem and permanently alter the world's financial order. Paterson approached King William III with a bold proposal. He would gather a group of wealthy merchants willing to lend the government £1.2 million, the equivalent of roughly $300 million today, an enormous sum at the time. But his innovation wasn't just the size of the loan, it was the structure. The money would never be repaid. Instead, the government would pay 8% interest every year indefinitely. To administer this revolutionary idea, Paterson suggested creating a new institution, the Bank of England.
The mechanics were unlike anything seen before. The merchants would deposit their gold into the newly formed Bank of England. The bank would then lend this gold to the government. In return, the government would pay annual interest from tax revenues, and the bank would distribute that interest to the original lenders. But here's the key detail. The principal, the original £1.2 million, would never be repaid. It became a permanent loan. Why would merchants agree to this? Because the interest payments were guaranteed by Parliament itself, backed by the full power of the government's ability to tax its citizens. As long as England could collect taxes, the interest would keep flowing. Even better, the notes the merchants received in exchange for their gold were transferable. They could be traded like currency. These notes weren't just as good as money, they were better because they earned interest. In 1694, Parliament approved Paterson's proposal. The Bank of England was officially chartered. The merchants provided their gold, the government secured the funds it needed for war, and a new financial era began. For the first time in history, national debt became a permanent feature, not a temporary problem to eliminate. And here's the part most people overlook. This arrangement was brilliant for the bankers. The government paid 8% annually on £1.2 million, amounting to £96,000 every year forever. The merchants had effectively purchased a guaranteed lifetime annuity from the state. As long as England stood and could tax its people, the interest would flow.
And if a lender wanted to cash out, they could simply sell their notes to someone else. The debt could change hands, but it could never be erased. Yet Paterson's true genius was still to come. What he built next would take this concept and transform it into a self-sustaining engine, one that would forever bind governments to debt. The Bank of England was granted the power to issue banknotes backed by government debt, allowing it to print paper money equivalent to the value of the loan. This marked the birth of a revolutionary concept: money created out of debt. The government's promise to repay its IOU effectively became currency itself. The more the government borrowed, the more money the bank could create. This became the foundational template of modern finance. Governments borrow, never repay the principal, pay interest indefinitely, and their debt transforms into money circulating through the economy. It was a brilliant system if you were a banker, but for taxpayers, it was disastrous. They ended up funding endless interest payments on a debt that could never vanish. Within just 50 years, every major European power had copied this model. France introduced the Bon Général. The Netherlands, already advanced in finance, formalized the issuance of government-backed debt. And by 1790, the newly formed United States followed this same path. Alexander Hamilton, the first U.S. Treasury Secretary, modeled America's financial system directly on the Bank of England, with permanent national debt, interest paid from taxes, and government bonds treated as currency.
William Paterson died in 1719, not particularly rich despite founding one of the most powerful financial institutions in history. Yet the system he designed endures more than 3 centuries later. The Bank of England still operates, and the British national debt has never been fully repaid, only refinanced, extended, and expanded over time. The debt trap was sprung in 1694, and ever since, every government has stepped willingly into it. By the early 1800s, European nations had fully embraced this new debt-based economy. They borrowed for wars, public works, and even day-to-day expenses. But there was still one major limitation. There wasn't yet a unified, organized market to manage and trade this growing mountain of government debt. Interest rates in the early 19th century were unstable, and only the wealthiest merchants could afford to participate in government lending. Then came Nathan Rothschild, who transformed this fragmented system into a powerful, organized machine. He effectively industrialized sovereign debt. The Rothschild family began as money changers and traders in Frankfurt. By 1800, the 5 Rothschild brothers had established banking houses across Europe, in London, Paris, Frankfurt, Vienna, and Naples. This network was unlike anything the world had seen. It allowed them to move funds across borders faster and more securely than any government or competitor. Using this advantage, they came to dominate the issuance and trading of government debt.
Nathan Rothschild, based in London, was the strategist who saw the full potential of this system. During the Napoleonic Wars, he organized massive loans for the British government. But his real breakthrough was how he structured these deals. Instead of lending money directly to the state, he purchased government bonds at a discount, then resold them to investors at a profit. This created a secondary market for sovereign debt, a place where bonds could be traded like commodities. The formula was simple but revolutionary. The government needed quick funding. Rothschild supplied it immediately, then passed the debt to investors such as pension funds, insurers, and wealthy individuals. The government received its money without delay, Rothschild pocketed the markup, and investors got a tradable asset backed by the state. Everyone benefited, at least on paper.
But behind the scenes, Rothschild positioned himself so cleverly that governments could hardly operate without him. His influence wasn't just financial, it was strategic. In 1815, at the Battle of Waterloo, Nathan Rothschild received word of Napoleon's defeat hours before anyone else in London. His private courier network outpaced official channels. Using this privileged information, he executed one of the most famous financial maneuvers in history. First, he began selling British bonds, leading other traders to believe Britain had lost the war. Panic spread, and bond prices collapsed.
Other investors, seeing Nathan Rothschild sell his British bonds, panicked and followed his lead. Prices plummeted across the market. Then, once the bonds hit rock bottom, Rothschild quietly bought enormous quantities at those depressed prices. When official news of Napoleon's defeat reached London the next day, confidence surged, bond prices skyrocketed, and Rothschild made fortune. It wasn't insider trading in the modern legal sense, but it was far more powerful: control over information and timing. This moment defined what became known as the Rothschild model. Control the information, control the issuance, control the market. By the 1820s, the Rothschild family dominated the European bond market. Any major government seeking to borrow, Britain, France, Austria, Prussia, or others, had to go through the Rothschilds. They controlled the investor networks, determined the terms of loans, and managed distribution across borders. They had effectively become the gatekeepers of sovereign finance. And this is where the real debt trap deepened. Before Rothschild, if a monarch or government defaulted, it was painful but contained. Creditors lost their money, the system reset, and new lenders could emerge. But Rothschild changed that dynamic completely. By making government debt tradable and interconnected across nations, he ensured that a single default could ripple across the entire financial world.
American bonds might be owned by a French investor, sold to a German bank, and then pledged as collateral for a loan to an Austrian nobleman. The ownership web became so complex that a single government defaulting wasn't just refusing payment to one lender, it threatened to collapse an entire international financial system. This was the true Rothschild innovation. Make global debt so interlinked that default becomes impossible, not because governments are moral or disciplined, but because the consequences would be catastrophic. From that point forward, governments were locked in. They had to keep paying, and often had to keep borrowing just to pay the interest on previous debts. The debt trap had evolved beyond permanence. It had become systemic. The debt trap had become inescapable. By the mid-1800s, the Rothschild family had reached the height of their power and wealth, richer than any monarch, and arguably the most influential family on earth. Their fortune came from one source: interest on sovereign debt. They didn't manufacture goods, build industries, or create inventions. They simply lent money to governments and collected interest endlessly. The system that William Paterson had conceived in 1694 was now perfected and industrialized by Nathan Rothschild in 1815. Every major European government was ensnared, dependent on constant borrowing to fund wars, infrastructure, and even daily operations. The trap had gone global.
By the dawn of the 20th century, the United States had become a rising economic superpower, but its financial system remained fragmented and unstable. American banks operated independently, the money supply was tied strictly to gold, and there was no central institution capable of managing liquidity or coordinating national credit. That's where J.P. Morgan stepped in, not out of altruism, but to protect and expand his own banking empire. In 1907, a severe financial panic struck. Stock markets crashed, major banks collapsed, and the economy ground to a halt. In the chaos, J.P. Morgan personally organized a private rescue operation. He summoned the leading New York bankers to his mansion, locked them in his library, and demanded that they pledge their own capital to stabilize the failing institutions. The plan worked. Confidence returned. The panic subsided, and Morgan emerged as the de facto central banker of the United States. But Morgan was 70 years old, and he knew he couldn't personally manage another crisis. What was needed was a permanent central authority, a system that would institutionalize control over the nation's money and credit. However, Americans had a deep distrust of central banks. The first and second banks of the United States had both been dismantled after public backlash, condemned as tools of elite power.
To overcome this opposition, Morgan and his allies decided to act quietly. In 1910, a secret meeting was arranged on Jekyll Island, Georgia. Attendees included Senator Nelson Aldrich and top representatives from the largest U.S. banks, all men deeply tied to Morgan's financial circle. For 9 days, behind closed doors, they drafted the blueprint for a new institution, one that would appear public but serve private banking interests at its core. That blueprint would become the Federal Reserve System. The Jekyll Island meetings were held in complete secrecy, and for good reason. The participants knew that if the public discovered that a small group of powerful bankers were designing the nation's monetary system, there would be outrage, possibly even riots. What they created was a masterclass in political deception. The new institution would not be called a central bank, a term Americans already distrusted. Instead, it would be named the Federal Reserve System, a title that sounded patriotic, decentralized, and public. It wouldn't be a single bank either, but a network of 12 regional reserve banks, giving the illusion of local control. On paper, it looked democratic and transparent. In reality, the structure was engineered to ensure banker dominance. Here's how the control worked. The regional Federal Reserve banks were privately owned by their member banks, the very same commercial banks they were supposed to regulate.
Those member banks elected the boards of their regional feds, and those regional boards in turn influenced the selection of the Federal Reserve Board in Washington. While the U.S. president appointed some governors, the financial elite maintained decisive control over the system. The most critical power, the authority to create money and purchase government debt, was concentrated in the Federal Reserve Bank of New York, the most powerful of the 12. And it was no coincidence that this branch was effectively controlled by Wall Street's largest banks, including J.P. Morgan's. In December 1913, the Federal Reserve Act quietly passed through Congress. Most lawmakers had little understanding of the bill's long-term implications. Once enacted, the system fundamentally reshaped American finance and vastly expanded the global debt trap. Before the Federal Reserve existed, government borrowing was limited by the amount of capital banks actually held. A bank could only lend money it possessed or could secure from depositors. But with the creation of the Federal Reserve, that limitation disappeared. The government could now borrow from a central authority capable of creating new money out of thin air to buy government bonds, effectively guaranteeing unlimited demand for government debt. The Federal Reserve possessed a unique power that changed everything. It could create money by purchasing government bonds. The process was deceptively simple. The government issued bonds to raise funds. The Fed bought those bonds using newly created money that didn't exist the day before. The government then spent that money into the economy, while the bonds, the newly created debt, sat on the Fed's balance sheet, backed by nothing but the promise that taxpayers would pay the interest indefinitely. This mechanism enabled infinite debt. Because the Federal Reserve guaranteed a constant buyer for government bonds, there was always demand. That meant the U.S. government never had to stop borrowing. Old debt could be rolled over into new debt forever, with no natural limit. Meanwhile, the interest payments on this endless borrowing flowed from taxpayers to the private banks that owned shares in the Federal Reserve System.
When J.P. Morgan died in 1913, the very same year the Federal Reserve was established, his legacy was cemented. He had helped design the structure that made the modern U.S. debt system possible. Without the Federal Reserve's ability to buy bonds with newly created money, the government could never have accumulated $38 trillion in debt. Private markets alone couldn't have supported such a scale. But with the Fed as a permanent buyer of last resort, there was no ceiling. The debt trap had become limitless.
By the 1970s, the system originally built by Paterson, Rothschild, and Morgan had gone global. Every major developed nation was now following the same playbook: borrow, roll over the debt, pay interest, and repeat. But the situation in developing countries was more precarious. Many of them borrowed heavily for infrastructure and modernization projects. Yet their revenues couldn't keep pace with their mounting interest obligations. The global debt system was approaching a breaking point. Then came Paul Volcker, chairman of the Federal Reserve from 1979 to 1987, who would make the trap permanent. At the time, the U.S. faced double-digit inflation exceeding 10%, and international confidence in the dollar was collapsing. Volcker made a drastic decision. He would stop inflation at any cost, even if it triggered a deep recession. In 1979, he raised the federal funds rate from 11% to an unprecedented 20%, the highest in U.S. history. The move succeeded in crushing inflation, but it unleashed another far-reaching consequence. Developing nations had borrowed billions of dollars during the 1970s when interest rates were low. But when Volcker raised rates to 20%, those same loans became crushing. Mexico owed $80 billion, Brazil $60 billion, and Argentina $40 billion, amounts far beyond their ability to pay. In many cases, the interest alone exceeded their export revenues. In August 1982, Mexico announced it could no longer meet its payments.
Under normal market conditions, this should have triggered a global financial collapse. American banks, Citibank, Bank of America, Chase Manhattan, and others, had lent most of the money. A Mexican default would have inflicted massive losses, potentially bankrupting some banks and shaking the entire international financial system. Paul Volcker could have allowed the market to clear naturally, letting lenders take losses and forcing a reset. But he chose another path. He orchestrated a rescue through the International Monetary Fund, the IMF. The IMF lent money to Mexico, Brazil, Argentina, and other struggling nations, not to reduce their debt, but to keep them current on interest payments to American banks. These loans, called structural adjustment loans, came with strict and often brutal conditions. Borrowing countries had to cut public spending, privatize state-owned assets, open their markets to foreign investment, and devalue their currencies. Essentially, they were required to surrender economic sovereignty just to stay afloat. And here's the critical point. The IMF loans did not reduce the debt. They simply rolled it over, keeping it manageable while ensuring it remained permanent. This is what makes the Volcker-era reforms so significant.
When debt became unpayable, the solution was not forgiveness. It was to restructure it in a way that guaranteed it would continue forever. This is the final piece of the global debt trap. The strategy was simple but ruthless. Restructure the debt. Lend just enough to keep interest payments flowing while extracting political and economic concessions in return. The debt trap became a tool of control. Nations that couldn't meet their obligations were forced to open their economies, sell state assets, and comply with foreign economic policies, all for the privilege of remaining in debt. This pattern has repeated consistently for decades. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Each time, the process is the same. IMF loans to ensure interest payments continue, Austerity imposed, sovereignty surrendered, and the debt never erased, only restructured into a permanent obligation. Paul Volcker passed away in 2019, but his legacy endures. A mechanism that makes the debt trap global and inescapable. Even when countries cannot pay, default is not allowed. They are refinanced into perpetual indebtedness, while interest continues flowing to creditors. The same banks, the same institutions, and the same system William Paterson began in 1694 still governs the world. To understand the full picture, consider how the four architects built a system in which debt is infinite and escape is impossible. Start with Paterson's model. Governments borrow, pay interest forever, and never repay the principal. Add Rothschild's innovation. Make the debt globally tradable, creating a web of creditors where default would collapse the entire system. Add Morgan's mechanism. Central banks create money to buy government bonds, ensuring unlimited demand and allowing governments to borrow endlessly. Finally, add Volcker's trap. When countries cannot pay, restructure instead of forgiving debt, keeping interest flowing perpetually. The result is what we see today. $315 trillion in global debt, government, corporate, and household. None of it ever intended to be repaid, and all of it is generating continuous interest for the financial elite. And all of it is bound together through a single fragile global financial system. A default in one major economy threatens collapse in all the others. Here's how the mechanism works. The U.S. government currently carries around $38 trillion in debt. Roughly $20 trillion of that is owned by the American public. Pension funds, mutual funds, insurance companies, banks, and of course, the Federal Reserve. These institutions purchase treasury bonds because they're labeled as safe assets.
But those bonds require constant interest payments, roughly $1 trillion every year. That money comes directly from taxpayers. In other words, citizens send money to the government, which then transfers it to bondholders, mostly wealthy institutions and investors. It's a continuous flow from labor to capital built into the very structure of the system. The remaining $18 trillion is debt the government owes to itself, primarily the Social Security and Medicare trust funds. The government borrowed from these programs and spent the money elsewhere. Now it owes itself, but in reality, taxpayers are still on the hook. When Social Security needs to cash in its bonds, the government must either raise taxes or borrow more to pay. That's a circular shell game, but the interest never stops flowing. Now, scale this system globally. Japan owes around $9 trillion, mostly to Japanese institutions and the Bank of Japan. Europe carries about $14 trillion, largely held by European banks and the European Central Bank. China holds massive domestic debt within its state banking system. Every developed nation operates on the same model: borrow, roll over, and pay interest forever. And they're all interconnected. Japan holds U.S. treasuries, the U.S. holds European debt through the IMF, Europe holds developing world debt through the World Bank. The entire structure is circular, self-reinforcing, and globally synchronized, meaning a failure anywhere threatens stability everywhere.
Everyone owes everyone else, and the interest payments flow upward to the institutions that manage and control the debt. This is why the system can never end. Take the U.S., for example. If it somehow paid off its $38 trillion debt, the money supply would collapse. Dollars are created when the government borrows. Paying off the debt would destroy those dollars, triggering deflation, depression, and economic collapse. The government cannot fully repay its debt. It must continue borrowing, rolling over old debt and servicing the interest indefinitely. The same logic applies globally. If every government attempted to pay off its obligations, the global money supply would shrink by about 2/3, leaving insufficient currency for trade. The system would seize. That is therefore structural, built into the financial system, and necessary by design.
And who profits? The institutions that hold the debt. BlackRock, Vanguard, State Street, Fidelity, and others. These asset managers control tens of trillions of dollars, investing other people's money, pension funds, retirement accounts, insurance premiums, into government bonds. From U.S. debt alone, they collect around $1 trillion per year in interest, plus additional returns from bonds in Japan, Europe, and elsewhere.
This $1 trillion annual flow is essentially a continuous transfer of wealth from taxpayers to bondholders. It's structural, invisible to most people, and not labeled as a tax. It's called debt service. But the effect is the same. Workers pay, institutions collect, and the debt never decreases. It's a permanent, self-sustaining mechanism. Now comes the final piece of the puzzle. The four architects of this system never worked together. They lived in different eras, but each one solved a problem in a way that expanded the power of bankers, and each innovation built upon the last. Paterson made debt permanent in 1694. Rothschild made it global in 1815. Morgan made it infinite in 1913, and Volcker made it inescapable in 1982. Together, they constructed a financial machine where governments borrow endlessly and pay interest forever. The real winners are not the governments or the taxpayers. It's the financial institutions that control, manage, and collect from this vast web of debt. Here's the final truth. $38 trillion in U.S. debt isn't a crisis to them. It's a business model. Every dollar of government debt is an asset on someone else's balance sheet. It earns interest, serves as collateral for more loans, and sustains confidence in the system. As long as people believe the government will keep paying interest, even if it never repays the principal, the machine keeps running.
The debt trap is complete. Escape is impossible without collapsing the entire structure. 4 architects, 3 centuries, 1 global system, and now every person on Earth lives inside it. If this changes how you see government debt, if you realize that the $38 trillion isn't a mistake, but the design, then you're beginning to understand how power truly operates. Subscribe to HistoMirror if you want to learn how the machine was built and who's still operating it. Because they'll never teach you this in school. They'll tell you debt is a problem to solve. But the architects knew better. Debt isn't a problem, it's the foundation, and interest is the rent we pay to live in their system.